there's a dogma that we were indoctrinated into is you set up your models, you trade a wide portfolio of markets, diversification is everything, that's your opportunity set, you don't chase parameters, you don't overfit your models, you never change, interfere with the model. If you have to wear a few drawdowns, you're going to wear a few drawdowns, right? And then that'll recover and your model will perform, and that's how you do things, right? I saw Martin Lewis give a speech on a podcast or whatever not too long ago, and they're still talking exactly the same stuff they used to talk about at AHL, as far as I can see, and which is fine, right? But it's fine until, you realise that the world has changed. So that was fine in the 80s, that was fine in the 90s, it was fine for a large part of the noughts. Do you know what I mean?
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Diversification, how many markets, guys, and sort of across what asset classes?
Yeah, I mean, we trade all the futures markets, that you'd expect to see to trade, commodities, financial futures, and we trade foreign exchange, OTC,
Okay.
And stuff. So
any equities or anything else?
No individual stock, just stock index futures, and that's how we look at that side of things. So it's all standard diversified fare. I mean, we have a universe of maybe 150 markets that we look at, including lots of FX rates. But at any point in time, we're only positioned in about 60 or 70, and have risk allocated to those. And we'll change that selection over time, depending on what we think is interesting, or what we feel might benefit the portfolio, kind of thing. But this is the thing, right? See, we were indoctrinated, right, into the AHL quant school. All these other funds, Winton, Aspect, and all these other funds emerged from that school as well, kind of thing, right? And there's a dogma there, right? There's a dogma that we were indoctrinated into is you set up your models, you trade a wide portfolio of markets, diversification is everything, that's your opportunity set, you don't chase parameters, you don't overfit your models, you never change, interfere with the model. If you have to wear a few drawdowns, you're going to wear a few drawdowns, right? And then that'll recover and your model will perform, and that's how you do things, right? I saw Martin Lewis give a speech on a podcast or whatever not too long ago, and they're still talking exactly the same stuff they used to talk about at AHL, as far as I can see, and which is fine, right? But it's fine until you realise that the world has changed. So that was fine in the 80s, that was fine in the 90s, it was fine for a large part of the noughts. Do you know what I mean? Right? Where it was okay to lose money in 90% of your portfolio and make all of your profits for the year on a Six Sigma move in cocoa because of a coup in the Ivory Coast or zinc. That was the good old days, right? That's how it was. But then it probably started with LTCM and Greenspan. But let's face it, the GFC, everything changed. Complete game changer, right? The central bankers took over the world, right? And everything really became more about what the dollar and interest rates and what macroeconomics and what they were doing with QE, and suddenly all that diversification became a complete red herring, because all the financial markets are completely impacted by the same thing all the time. Doesn't matter, whether it's cocoa or whether you're talking about the Bund future or whatever, right? They're all being impacted by the same macroeconomic scenario that's overarching everything and not about to go away anytime soon. So this whole, Paul and I sat there, right? And we're looking at it and we're looking, to try and, we're using sophisticated techniques to optimize the diversification of our portfolio, and you're trying to allocate to diverse, what you believe to be diversely correlated and volatile markets and stuff like that. And yeah, the methodology itself is doing its job, right? But as we described in terms of our pattern recognition DSP type framework, linear, non-linear, contextual sort of framework, you can have the best mousetrap in the world, right? But if there aren't any mice, you're not going to catch any mice, right? So if you're allocating to these markets that you think you're diversified, but if they're not actually doing anything interesting, you're not going to make any money. You're just going to hemorrhage money, right?
Yeah.
And so we had a few rough years, and then while this was going on, because central bankers essentially destroyed the volatility in different segments of the CTA world, right? Firstly, commodities volatility died in the early
I can
part
see
of the
the
last.
global macro beast coming out in your Sanj. Keep going.
Yeah.
Exactly.
I won't go to. I'm just trying to describe our thinking. I'm definitely not going to tell you what I'm thinking
No,
about.
this is really interesting. Please tell us what you like.
So we had some epiphanies, right, on the basis. So you look back. Paul and I have been doing this for 30 years, right? I mean, our track record's 20, but we were at AHL when we were young. So we've been CTA men for 30 years. We've seen models being run through different cycles, different market conditions, different events, Nick Leeson, the great financial crisis, the dot-com, but you name it, we've seen it, right? And so you suddenly, at some point, you got to try and think about what you're doing at a very fundamental level. And you know what, right? I mean, yeah, you can create real diversification if you do something really, really different. So if you're a trend following CTA and you then suddenly add a program that's a bond arb program or something else, right? Then yeah, that'll be diverse. That you're adding, but if you're within the remit of trying to be a trend follower in CTA, there are mathematical financial problems that are essentially unsolvable because you can't actually predict the future, no matter what anyone says, right? But the thing is, although they're unsolvable, or you might attempt to carry on researching better techniques to try and add value or solve these things, you can circumvent these problems by just being better fund managers and a better trader. But that requires something that you're not allowed to do, because for 20 years, you've been visited by all of the largest fund of hedge funds and clients in the world who sat in your boardroom and said, you don't tinker with your model, do you? Right? And so suddenly we realized, hold on a second, right? Commodity volatility died. Then towards the end of the last decade, FX volatility died, and when you start to recognize this, and you start to think, what's really going on here? Well, one, the central bankers are dominating everything. Two, diversification is a marginal risk management tool at best, because why use correlation as a proxy for your risk, which is not even contemporaneous when you're measuring it in terms of when correlation events actually occur or changes in correlation occur, when you can directly measure market volatility and have direct measures of risk in the positions that you have. Why use proxies for risk instead? So why do you need portfolio theory? Because one thing that we realized and we learned is that whether you're making money or losing money as a CTA, whether you've got a mixture of long positions and short positions in various different markets, when it all hits the fan, right, all of those positions move together. Everything's coincident, not correlated. It's coincident. So diversification is a marginal risk management tool at best, right, where there's way better tools to manage actual volatility and risk in your positions. And so, yes, maybe you want to have a diverse set of markets because you want to have a diverse, opportunity set, right? But your real opportunity set is what's going on in the collective as a whole. So we realized that we needed to manage that risk in a discretionary way. So now, as fund managers, we're kind of like, well, if we want to protect our downside and we're worried about what Jerome's going to be saying tomorrow, well, we'll cut the risk and sit out for a few days. We'll just go to zero, right? And we'll manage it, and we'll see what happens till there's more clarity as to what we think is going on. And we've been doing that ever since November 19, and that we've done other various kind of sort of interventions into the way the models run. When we didn't want to be long stocks, we made
that reminds
stocks.
me of Sanj, of like the GameStop blow up in stocks with a Reddit crowd on the internet, driving up these prices of these stocks, and to my mind, it was a very valid decision for even a quant to say, I'm out. I'm not going to short at the moment, or I'm certainly not shorting anything in that genre. Like just reading what's happening on the ground at the time, seeing how totally outside your playbook it is, and just making a logical decision about capital preservation.
You can't code that.
Absolutely,
right?
yeah,
you can't
completely
code
right,
that.
Simon.
That's the thing, right? Is that these decisions are contextual, right? And you can't code context in that way, right? And we know, because we've tried various strategies over the years of tested ideas of let's harvest our profits automatically when we're this or that or blah blah, but you just end up crimping your profits and limiting what you can make. It has to be in the moment, right? It has to, you cut your bond positions because SVB collapses on a Friday, and you cut your bond position on a Monday to avoid the Six Sigma move against you, because it looks like bonds are about to spike on the back of a banking crisis. You can't code that, right? We did that though, right? Do you see what I'm getting at, kind of thing, right? And we avoided that Six Sigma move, right?
Yeah.
So people are starting to. This is showing up in our numbers. Ever since November 19, we've managed to avoid some significant draws. Not all of them. We've structured our positions in a certain way based on our macroeconomic thesis of what we think markets are going to do.
Have you missed any opportunities, Sanj, through this process?
Not really, because we're still maintaining a diverse portfolio of markets, and we're not looking to predict what markets are going to do, whether they're going to go up or down. No, we're letting the models do that. We've got the DSP and the pattern recognition to do the directional stuff. We're looking to more manage the risk and manage the downside, and structure the portfolio in a long-term sense for things that we think are interesting, that they're actually going to move. If orange juice breaks out of a 15-year range, sideways range that it's been in, it's probably interesting. Again, there's probably something going on. Even if you don't know all the fundamentals of orange juice, you'd probably think, hey, it's broken out of a 15-year range where it's been sideways for 15 years. It's broken out, it's come back, retested the top, and it looks like it's about a trend. Maybe there's something there we should be investigating and sticking it back in the portfolio, or weighting it up slightly, kind of thing. We're never going to stick all of our eggs in one basket, but this is kind of where we're at now in terms of our thinking.
Sanj, this is sort of like a discretionary overlay to manage adverse risk. So is this, you've got this t-shirt on called positive skew. Do you think this is actually enhancing your positive skew with this discretionary overlay?
We look to work in harmony with the models. So like last year, for example, when the Bank of Japan intervened on October the 24th, and suddenly all the trends turned, and the Fed leaked a story about a pivot at the same time, and blah blah. Everything, all the trends turned at that point. Everybody was short bonds, everyone short stocks, and that was the beginning of the bear market rally that we've seen this year, and it started in October 24th, I think 21st or 24th, and we saw that happening. We caught all our risk, and we banked our profits for the year and thought, right, we'll just sit out. Now, we didn't know how bad it was going to get, that drawdown, but it got worse and worse and worse, to the point that, right, we're getting now towards the beginning of the new year. Now, by the time we got there, because remember, we're still running our models. So what happens when you get these events, these trend turnaround events or consolidation events or drawdown events, is that your signals start to become reduced, and your positions and your signals start to become more mixed. Now, we didn't actually have any positions because we'd gone flat everything, but the models are running and the signals reduction was occurring. So by the time you've now hunkered down, which is normal in these type of scenarios, that your model's now hunkered down, then new stuff is ready to emerge. So come January, we're like, okay, well, we're not sitting here looking to predict what's now going to happen, whether stuff's going to retrend or whether we get new trends. Let's give risk back to the model. So we're looking to work in harmony with the normal rhythms that you see of a trend following model that we've learned over years and years and years. So that's what we're looking to do. We're looking to protect the downside for the investors, and we don't want to be intervened in the model, and we don't want to. We might make portfolio decisions on a long-term basis, but it's not our philosophy to be constantly interfering with the model. But we're not afraid to do it. And you know what? What's more important is now we're out of that dogma that we were indoctrinated into. We're not ashamed to tell anybody about it either.
Yeah.
Like, coming out of the closet, Sanj.
Exactly.
Yeah.
Whereas we used to be.
How do your AHL peers think about this?
They're shocked.
They are. They didn't
absolutely
invite
shocked.
They didn't invite you to the barbecue.
They're going to find out. They're going to find out when they see your this podcast again.
Yes, they're going to see this, and then you'll be off the invite list.
That's
we can see the shock in their faces when we tell them that.
Indeed. So, Paul,
you're what? You did what?
Yeah, Paul. Let me ask you then. Sanj has just mentioned protecting the investors from the downside. So, what is risk management for you guys then? Like, I think Sanj mentioned that looking at risk, if I understood it correctly, at a portfolio level probably wasn't really the focus, given the lies about correlation, perhaps. So, what is risk management to you guys in a simple sense?
So, as Sanj says, we do try to work it in. We do try to work in harmony with the model, so that we build as many risk controls into the model as we can. Yeah. So the model has volatility filters. So basically, it scales up and down based on market volatility. We've got liquidity filters, which are looking at basically liquidity risk associated with the market, which also affects how we execute. Yeah, we've the way those markets are all linked together is based on we don't really use correlation as such, but we do have almost like a hierarchical risk parity type structure with our portfolio. We're basically having subsectors of like signature markets that work in the same sort of way. We bucket them together, and then we allocate risk in a hierarchical manner to those markets. So we're kind of like, in many ways, it's the interesting thing about correlation. Yeah, is correlation can come and go. Yeah, so you can have a lot of FX markets which are permanently correlated with the dollar. Yeah, which is what you'd expect, except sometimes they're not, when there's something interesting going on in that area. Yeah, so we're but if you use a pure correlation measure, they'd look as if it was very, very correlated. So we have our own measures for that, as well as this as we said earlier on, a discretionary view of which things should be with each other and which things are very different, to which things are the same. So from that, we are able to come up with a risk profile.
Paul, just a traditional CTA typically is involved in correlation, all of these things, but what you're saying is your DSP, your pattern recognition, they're taking care of all of that effectively, and then you've got your discretionary overlay on top of that to sort of work in harmony with the markets.
Yes, it's we build as much risk control into the market and the models as possible, and where there are risks outside of those models which they cannot describe, that's when our discretion comes in, and that is all about context.
Do you stops?
No.
Yep.
No. The patterns in a way act like an intelligent stop. Yeah. So because it's rather than have like picking a level of which you think is interesting. The problem with levels, is they get tested and broken and retested and broken again, and you get false breakouts in these levels occurring all the time, where market participants are taken out at certain levels and then it retrends back to the original direction. So stops can be very fragile, They're a very fragile methodology for models. People think that they're limiting risk by having stops, but what they're doing is they're just changing the distribution of their returns. They're not actually limiting the downside. They're just changing the skew of their model. But with patterns, we basically it only effectively triggers a reduction of position, if a sequence of events occurs. So it's like it has to be a sequence of turning points that are triggered, before we effectively get out of that position. So rather than a single condition, it's multiple conditions. So that reduces the chance of you being spoofed into a level, which happens all the time in the markets.
Paul, have you ever been caught in a left tail event, or is that not occurred in your history?
The thing is about these kind of events, is that our models will take care of it to a certain extent. We try and avoid it from a discretionary perspective as well. But you can never remove tails from the distribution of your returns. So we will always get caught at some point in negative and positive tails. Our job as fund managers and researchers to try and build models and act accordingly to try and limit those as best we can.
What about the ongoing research function then? What's the focus of day-to-day research?
We're doing all sorts of things, actually. We've got a team of guys which work for us. We have some ETF models, actually, which we're looking at the moment, which are quite interesting because ETFs are a huge growth sector and are interesting because it's, in a way, it's a lot more accessible as an investor's instrument because of the just the prevalence of ETFs, and futures is often quite difficult to set up a futures account, I think, especially now. So effectively that we'll be able to potentially access a whole range of newer investors which haven't been able to access futures in the past. So that's an area of research for us. So that's like accessibility. We continue to look at new models, and also methodologies for improving our research as well. So we tend to use a lot of AI techniques more as assistive techniques for research rather than to actually implement our models. So we're looking at those kind of things, and we always look at execution research as well, improving our execution. So these are kind of the main strands. The patterns and the DSP, the way they work, we look because patterns actually work in a fractal way. So we have been looking to see how patterns can be extended beyond its current implementation to have more detection of coincident behavior across market sets. So those are some of the sort of key ideas. So basically try and look at what we've got and improve that, but also look outside of our universe for new ideas and different ideas that inspire us to come up with new trading models. So that's we always find we read a lot of other scientific articles.
I've noticed you've written some great blogs on quantum computing and what you call the financial singularity. Without going into it in too much detail, do you want to give a brief summary of those ideas? And you're involved in quantum computing, I believe.
Yeah, so I'm an advisor for a quantum computing startup in Canada. The idea being is there are some financial problems which are intractable by current computing technology. So in portfolio optimization with a universe of 100 odd markets is fine, but if you're looking at 10,000 or 20,000 single equities, it becomes suddenly almost impossible to optimize that portfolio. So there are quantum algorithms for doing this sort of thing, but quantum computing at the moment is in a very, very early stage. So very much a lot of the research work at this stage is almost like getting ready for when the hardware is available and capable of implementing these kind of algorithms. Interesting enough, the algorithms have been developed, but
what is quantum computing for the absolute novice?
Well, normal classical computing relies on binary values. So basically, an individual bit within a machine can be 0 or 1. And with a quantum computer, you actually set up your qubit so that it can be either 0 or 1, or potentially any state in between that. So when you have multiple qubits, rather than having, say, for example, you've got 8 bits of a classical computer, you have 128 possible states. When you've got 8 qubits, because each one can be 0 and 1 and any state in between, the number of states you can have is exponentially increases the number of qubits you add. So you can set up your quantum algorithm, so that you when you actually execute your code, all of the possible states all collapse when the waveform collapses into the potential answer. So it's in a way, it's almost like an algorithm is sifting through all the possible states that is possible for this algorithm, and resulting in an answer. So it basically allows you to do computations with data sets and combinatorial problems which are way outside of what computers are capable of doing.
And this financial singularity?
Well, in many ways, this comes down to a lot of the things that myself and Sanj talk about. So, like, what do traders do? Traders are effectively finding inefficiencies in markets. They're finding alpha. Obviously that's the term we tend to use, but that's what we do as a job. We're trying to build models, do research that find alpha in the markets. And then if we found that inefficiency in the market, we then take a position, and then when the rest of the market agrees with us, hopefully prices rise or prices fall or whatever, and then we make money from taking that position at an early stage. Okay. So that alpha, is what we're trying to capture. Now, those inefficiencies, are based on stuff that we know. Imagine that if everybody knew everything about the markets. Okay. Now, obviously, humans aren't capable of absorbing all data about the markets. But a super connected, super intelligent machine could potentially do that. So if a machine is able to absorb all the data that's going on in the markets, then there won't be any inefficiencies. There won't be any discrepancies to pick up on, because it'll be able to spot them straight away. So if there are no inefficiencies, there's no alpha. So there's no alpha, there's no investment gains. So the more of these efficient machines trade the markets, the less the inefficiencies there will be, and alpha would drop to effectively 0. All humans will have
And
left
that's when
to trade the
markets would
markets.
stop, wouldn't it, Paul?
That's
Like,
right.
what's the point of
Markets
a market
essentially,
if there is no
that's right.
opportunity?
They would flatline. Markets would flatline. And there'd be no change in the market except on events. So what you'd end up having is market prices would look like a step chart rather than a chart we used to seeing today. So basically, there'd be no investment opportunity. No pensions, no savings. The financial world would collapse. But no one would dare turn off the machines either. Because as soon as they turn them off, then the whole thing would collapse again. So you become this difficult situation. So the whole thing with the financial singularity is like a thought experiment. Is if you take super intelligent machines, if you take what we have today and you extrapolate it to a point where markets are not tradable by humans anymore, and all price differences disappear, what happens then? We don't know. Hence the term singularity. Because in the term
It reminds me
physics,
of the heat death of the universe, Paul.
So in physics, the singularity is obviously they call it that. They don't know what happens beyond that. So the whole thing is really a bit of a thought experiment. Whether we'll get there or not is, again, part of a wider discussion. Whether we're there already is part of a wider discussion. Whether we should prevent it, through regulation or controls, there's also part of a wider discussion, perhaps part of the same discussion that we're having about AI ethics at the moment. So,
well, if we see your firm disappear into a black hole, we'll know you've got there.
We'll know you found it.
We'll be taking the whole financial world with us if that happens.
Sanj, I want to ask one last question from my side anyway on the models before asking you about other aspects of what you do that are adding edge and opportunity. But the both of you have talked about buckets of like contracts, so to speak. Are you deploying the slightly different models then tuned to those contracts, and then are you deploying these models on all of those contracts individually or as a portfolio? It sounds like capital can flow in and out and from one place to another in a way that's different to that AHL indoctrination that you mentioned of just sort of running the same model on every contract and allocating 1% of your portfolio to each contract. So how does that look for you guys?
Yeah, well, I mean, firstly, what I'd say is that we don't know what AHL does now. We don't know what AHL's been doing for, we were there 30 years ago, right? At the end of the day, right? So I'm sure they're up to all sorts of very clever, interesting things, beyond even what we do. But, in terms of what we do and what we look at, I guess it's a difficult thing to understand unless you actually do it, right? But in a model scenario, you don't want to be, right. At one stage we discovered, right, that our model was underfitted, not overfitted, right? It was actually underfitted, right? And so, and when we realized that, we realized why it was underfitted, right? Which I'm not going to go into, but the conclusion was that we needed to look at different market sectors in a different way and see whether or not they had their own idiosyncrasies in terms of model fit, right? Which we discovered that was true, right? Especially given our previous scenario of being underfitted. So we essentially tightened our fit a little bit. We don't believe that we're in any way overfitted. We're very mindful of the robustness of models and changing of environments and being too optimized to one set of data. So these are kind of traps that we would never fall into. Our pattern recall can't be optimized in that way anyway, right? Because it's nonlinear in itself, so it's not reliant on those kind of fitting parameters, that methodology. But the DSP can be a bit more fitted, and so we tightened our fit, and therefore, right, realized that different sectors needed to be treated slightly differently from a model fit perspective. So we adjusted that over time, years ago, kind of thing, when we learned about this stuff. So that's how the model's set up from a sectoral perspective in terms of fit. And then in terms of the risk, though, that's a separate thing. Where we've changed the way that we've done risk in the portfolio over time. In our early days, we were highly we were kind of, we ran 10 sectors. A lot of them were commodity sectors. We treated them individually and we allocated risk to them. So we ended up being, because of the way the signaling worked back then, we ended up being sort of always on average 60 to 70% on average weighted to commodities, which was back then a good place to be. Post the GFC, that wasn't a good place to be. So that's when we spent a few years changing the way that we did the portfolio risk allocation, and we used more of a portfolio theory approach, which lent itself away from our original high commodity. It moved us away from our original high weighting towards commodities, higher weighting towards commodities, and moved us more towards FX markets in a way, actually, as a higher weighting in the portfolio than anything else, because we were still part of the whole dogma thing. We're CTA. We're not going to just because the
commodities only.
Yeah, commodities only, and none of our investors want us to be equity traders because they've got fund managers that do that. So we're going to have our equity indexes, but we're not going to allocate 90% of the portfolio risk, even if the Fed is printing $9 trillion and cutting rates to zero. That's not our game. That's not what our investors want from us, right? That was a mistake, by the way. So we should have done that, and then we would have made 30% a year in the S&P, for those 10 years. And so this is when so when you look back at these kind of things and dogma and what we viewed as sacred cows that weren't really, that's when you start to think about how you want to evolve and how you want to change things. So that's where we got to this point, towards the end, about 2018, where we realized the portfolio weighting we were using that was allocating a lot to FX was getting murdered because the FX volatility got crushed to like almost nothing by 2018, right, with all the interventions and everything else. And so there we changed again. And what we decided to do was position ourselves more orientated to take advantage of what central bankers were doing, and the stocks were still going up at the time and what have you. So we kind of sectorized the portfolio into main broad sectors, right? So we got a risk allocation to equities, index futures, a risk allocation to long end bonds and short rates, a risk allocation to FX, and then commodities as well separately. And then we busted out precious metals because we wanted to have a separate allocation to precious metals, not lumped in with all the other commodity sectors. And we just wanted to look at the portfolio in a very broad structural way, because part of the epiphany of diversification being a bit of a red herring at the moment. The other epiphany was that unless something really interesting is going, unless you got like back in the day, China emerging onto the world stage, production of bioethanol emerging, and all this huge interest in commodities and what was going on with China buying commodities and all that. There's got this huge swathe of media interest, investor interest, or whatever. The sector as a whole not actually going to do anything. Do you see what I mean? So that's why we lumped all these things together, because we want these things to be allocated from a risk perspective to in a way that the whole sector needs to be interesting, and we wanted to manage that risk and those risk weightings in that broad way. Now we can still adjust risk individually. If we fancy, a bit more crude oil or whatever, because we think it's going to go up or whatever, we can weight that up or down. So we started to then, that's where the discretion came in. So rather than automatically weighting this portfolio, we now started to adjust the risk. We keep it broadly diversified and more or less equal, but we now adjust it ourselves. So if we fancy, being slightly 20% overweight relative to the other sectors in commodities, then we'll do that, or underweight something else. And the other kinds of things that we've done is that, when we cut the bond risk on the SVP VB collapse weekend, we didn't actually cut the risk to zero. All we did is we forced all of our models to be long only, which long only, which actually cut all of our short positions, because if you force them all to be long only, then you can't have any shorts, right? And so that quickly cut our risk, but allowed us, rather than going to zero, if the markets did at that point rally and the bonds did rally, we wanted to take those long positions. So rather than cut risk to zero, we just switched the way that we're going to allow the models to trade, kind of thing, for temporarily to see what was going to happen there.
And Sanj, at the moment, you're both sort of long and short. You have no sort of bias.
Yeah, we are long and short everywhere, but we're a little bit short only the stocks kind of thing. We don't really fancy taking any long equity positions kind of thing. So since last year, that's worked really well for us, because every bear market rally fizzled out and ended badly, and no one captured those returns. It's only the one since last year that has extended all most of this year that maybe has been a little bit more problematic. But even that, had sold off recently down to the lows and then bounced again from there. So that's an unclear scenario for us as to what's going on there. Like I said, we don't force the models to take a position, right? We might structure things so that they're only allowed to do one thing or the other, but it's the models themselves that have got to decide to go short.
Yeah.
Do you see what I mean? Kind of thing, or long, or whatever. So we don't trigger signals.
I'm very mindful of the time, but I definitely don't want to leave you guys without you having said everything that you'd like to say. And Rich, you might have some final questions, but we should really wrap up pretty soon. People's attention spans are notoriously short. I mean, Sanj, if you're willing, I wouldn't mind, or if you're interested in it, you may not be hearing a bit of your sort of macro outlook, completely, separate to the quant and the models. But if we don't have time for that, or we're best to tune into your blog, we can do that as well.
No, look, at the end of the day, right, you can't predict the path of markets, right? You don't know how you're going to, but you can potentially predict where you're going to get to based on what's going on in macroeconomics. So, you got a position for the win, right? And that means the path in between might be a little bit difficult to wear if you've already positioned yourself. But the win is, right, it's not that complicated, okay? At the end of the day, we're not going to see a soft landing here. That's almost never happened. We've come out of the conditions that are the worst ever for money printing and levels of indebtedness. So why assume the bust that's going to emerge from that is going to be better than it has been in the past? It's going to be worse than it has been in the past, right? So at some point, the emperor's not going to be wearing any clothes. Inflation's going to resurge, just like it did in the 70s. Inflation's actually cycled up and down in waves, right? The budget deficits that they're running are going to explode as this massive debt burden that the US has piled up now needs to be rolled over at much higher rates over the next 2 years.
Yeah.
So their budget deficit at now 2 trillion will be 4 trillion before you know it. They're saying the budget deficit's currently 2 trillion, but they're adding $1.25 trillion to their national debt. So they're spending 4 trillion a year, but they're saying the budget deficit's 2. Massive budget deficits is inflationary. And we're not even in the worst. We are in recession. Leading indicators have fallen for 18 months straight. That's never happened, right? Or whatever. So we are in recession. They're just lying and whitewashing it all. But and why wouldn't you, right? At the end of the day, when you've got to issue loads of debt, you are going to manipulate the numbers. You are going to lie about the strength of the economy. You want people to turn up to your bond auctions and take your debt, which is happening less and less, right? So you position for the win. The win's going to be, we're going to see a very hard recession. It's going to be really bad. It's going to come into force probably early next year, right? When that happens, the Fed might maintain its hawkish policy and leave rates unchanged because they want to leave them higher for longer. But if they start to cut, they'll only do it in response to really, really dire consequences that they can't cover up anymore. And when that happens, right, the dollar will get trashed, because if you've got an environment that's inflationary where the Fed's cutting rates, the world will wake up to that. Dollar will get trashed. We'll see oil, precious metals, commodity markets. They're going to boom in the next stage of this of a super cycle.
You're buying Bitcoin?
No, I can't stand crypto. It's a cowboy environment. Crypto will crash. I mean, look, crypto, right, is an asset bubble like everything else. Zero rates, right? Zero rates and all that money printing for years and years and years has fueled, right, asset bubbles. Crypto being one of them, right? People chased yield. and invest in things like art and crypto and whatever. So the thing is, as well, what you got to understand, I think is really important to understand, is inflation itself. So what we've seen is we've seen a wave of inflation since the pandemic because they injected so much fiscal stimulus directly into the money supply and the real economy with all money that got spent immediately. So it created this wave where the CPI shot up, and that wave is now subsided. But what we've not seen yet, right, is the entrenched inflation that's going to continue to get worse based on the trillions and trillions and trillions of dollars worth of money printing central bankers did all over the world that didn't feed through into the real economy straight away. It fueled into asset bubbles, bond market bubbles, stock market bubble, asset price bubbles of all sorts. But eventually that money will come out of the financial system and go and go into consumer prices as well. That's the whole thesis and the basis for trying to understand that inflation is not going away. So all these people think that inflation ticked down by what, 0.1% last month, big deal. The core's still at 4%, right? That's hardly moved more than 0.5% in 2 years, right? And so that's troughing. It's not declining, it's troughing. And this is going to get, this situation we'll see very soon getting worse and worse and worse. And then what you got to understand as well is why central bankers screw this up so badly. Apart from the fact that their actual non-independent agenda is to facilitate the spending of the government of the day, which clearly they're doing, right? And every central bank does, like the Bank of England does it as well, or whatever. That's their actual agenda. They're not independent in that respect. But the reason they make so many policy errors is, think about the inflation number they're focused on, the core, right? Ex food and energy. They're focused on the least volatile, most non-reactive, right?
Yeah.
Inflation measure. So no wonder if they're basing their entire policy on the thing that reacts the least and with the most lag to any changes in real inflation, then clearly they're always going to be behind the curve in their policy response to anything. Do you see what I mean?
Yeah.
So this is where we are, right? So you want to be in, as far as I'm concerned, you want to be in, if you want to be in equities, you want to be in cash rich, high dividend paying companies, non-US, definitely, because why take the dollar exposure? Why not just say, hey, the dollar's rallied for ages, and let's take advantage of this strong decade level dollar or whatever, even though it's come off from its
Sandra,
high.
a farm and a gun, would you get those two items?
Oh, look, the whole seeds of the new currency thing. Yeah, I'm with that. At the end of the day, I'm definitely a doomsday prepper. And you want to have a few cases of baked beans in your garage,
Rich has got a few cases of beer.
Yeah, beer too, right?
That's probably a bad strategy.
Yeah, so you can see, yeah. So macroeconomically, you can see where we are now. Given bear market rallies are vicious, and we've all seen this where we are with this bear market rally. This is it. It could be about to turn now. But even if we see a new high, it's not likely. There's no fundamental basis at all, right? For that would support some kind of new massive bull market in equities. Where do you get that from? Where could you possibly get that from? This is unemployment numbers are always the lowest just before a recession starts, then they explode, right? Right? The markets cheering what they believe to be might be a Fed cut or pivot next year is completely wrong. Stock markets don't crash when the Fed hikes. Stock markets crash when the Fed cuts, because they're cutting in response to something really dire that's going to occur. That they always start. That's when the stocks crash. So if markets here are cheering a Fed pivot or a Fed rate cut or whatever, that's it. That's the timing for when the stocks are about to crash. And why not? Because we are due to come into this recession. At the end of the day, the yield curves have been inverted for so long and been telling us that it's coming, and we're pretty close. Corporate profits are going to decline. CEOs are warning all over the place. Bankruptcies are through the roof. Where's all this good news? Where's all these good fundamentals, right?
Yeah.
So
Sanj,
sorry, go ahead.
Well, no, we could talk all day and all night. Yeah, I actually made a little post in March 2020, which in Australia, really, we were just hearing about COVID for the most part, and obviously the market started crashing at that time, and I just sort of heard, okay, we're going to print trillions of dollars a minute to get us out of this mess. Oh, and we're going to lock down the whole world, and we're going to bring everything to a standstill overnight. And I thought, oh well, yeah, that sounds utterly insane. And I posted. I posted some pictures of a friend's stamp collection, because a friend actually has stamps from the German hyperinflation period. And it's just incredible. People have got no idea. It's a stamp with 4 marks written on it. That was the price, 4 marks. And then the 4's officially crossed out, and it changes to 200. Yeah. And then the 200 is crossed out, and it goes all the way up to 2 million.
Oh, goodness.
Yeah. It's like the Zimbabwe dollars, where they and but this is the thing as well. This is another thing. So what you're describing there is how do you not get inflation if you pump a load of money into an economy you've shut down that's not producing anything? Right? So you pump a load of money into an economy that's now not producing anything. So you got all this money chasing fewer goods and services, right? And that's the thing that everyone's going to get wrong about this recession as well, and the market's going to get that wrong too. The recession itself is going to be inflationary. You have people losing their jobs. You have an economy that's less productive. Then you're doing essentially the same thing. You've got a less productive economy producing less goods and services for people to buy. So prices go up, they don't go down.
Stagflation.
You see what I mean? Exactly. Right? That's what we're looking at here. So you have to position yourself for that. Position yourself for the win.
What else are you working on, gentlemen, and anything else of interest that you'd like to share?
This is the thing that there's some of the newer things that we're working on. I think what we'd like to do is maybe come back and update you on those once we've actually got them going.
That'd be great. We'd love that.
Yeah, because then we could just talk, because we've done all of this now. We could just talk about those, and we've got some exciting stuff happening in bonds and things like that. But I think what we would rather do is actually get it going, prove the concepts and stuff, and then we can come back and talk about it more meaningfully.
Love it. Good idea.
Yeah.
We can be your channel.
Yeah, that'd be great. That'd be great. Love talking to you guys.
And tell Rich where he can get this shirt, positive skew
I need
shirt.
I need it.
We should be selling it on our website. We'll have to get some, Rich.
I make my own T-shirts. You just go onto a website, type in what you want to print it on the shirt, and they send you the shirt.
Brilliant.
Very nice. Very nice.
I'm
envious, Sanj.
I did it in italics. Actually, I should sell this because everybody likes this kind of thing.
Yes.
Yeah, they do. Paul's banned me for wearing my. I've got another T-shirt that says "No." There's a big "No" on it. He's banned me from wearing it. Wearing it to any meetings.
Yes,
you can use that at home, but not in client meetings.
All right, gentlemen.
We always say yes to clients.
Yes. Okay, listen, how can the viewers get in touch, stay in touch? Can they follow you on Twitter, X, or LinkedIn, or shall we direct them to the website? What's your best channel?
I mean, if they want to get information on our strategy and what we do, then they have to go to the website and request info. Anyone that wants to can follow me on LinkedIn if they're so inclined to do so. And that's it really.
Website, so you can read the blogs I've written on there, which are about various different subjects about the strategy, but also some wider things. But I'd say if you want an up-to-minute commentary, follow Sanj on LinkedIn. I'd say that's a really good
okay, and what's the website address again?
Yeah, h3im.com.
Fantastic. We'll put all that in the show notes, of course. And it's been really good chatting, guys. What a fascinating show. It's going to be our best hit, no doubt. And, we're really keen to do a follow-up. So thanks so much for all of that. And I'll be off.
Thank you for inviting us.
Digital signal processing.
Yes, thank you for inviting us. And, it's been I've been wanting to talk to Rich forever, so
look at you guys!
There we go, Sanj. Big hug.
It's been very enjoyable talking to you and Rich. So thank you very much.
Thanks, guys.
When we're next in London or when you're next in Australia, we'll do a catch up. We just had one here. We just had a big trader catch up. So look out for that podcast. It's going to come out very soon. And we'd love to catch up in your neck of the woods one day.
Definitely, guys.
Yeah, that'd be brilliant.
Absolutely.
For sure.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.